You can start, Magnus.
Hello, good morning, and welcome to everybody attending our webinar this morning, the last one for the year 2024, which has been, believe it or not, a very good year in investment markets. I'd like to welcome everybody listening today, giving up your time. I'd like to welcome our speakers, Anthony Ginsberg. We speak to him somewhere in California. It's about midnight. We just before the Thanksgiving weekend. So Anthony Ginsberg, ex-South African, left South Africa about 30 years ago to set up his businesses all around the world. And we also say hi to Sean Peche, who runs the Rainmore Funds, which is in our portfolio of funds that we've been offering to our clients for some time. And Sean, also an ex-South African, also ex-UCT. And he is talking to us somewhere from Scotland, such as the technology world that we live in today. I'm speaking to you from the island of Mauritius, and Deleen van Wyk at the controls is somewhere in South Africa. I have no idea. But having said that and welcoming everybody, let's quickly start with our topic today. But before I do, I just want to put into context why we're having a chat about the impact on global investment markets after the Donald Trump victory. Now, whether you like it or not, or whether you support Trump or not, the fact is that the outcome of the American presidential election plays a very important role in financial markets. This year, more than half of the world's population went to the polls, including countries like India, Pakistan, Bangladesh, South Africa, Botswana. Namibia is having an election today, the United Kingdom. I think Argentina had an election. But none of these countries are important enough to have a discussion about the role of the outcome of that election than the United States. And the reasons are quite simple. The last 15, 30, 40 years, the American economy has developed into the biggest economy in the world. It still is about 45 to 50% of world GDP, but its financial markets have an even larger share of global markets. And I'm talking about bond markets, currency markets, and also the equity markets, which range from about 55 to 65% of total world market capitalization. So what happens in America counts. It affects every single investor around the world, including us in South Africa. And that is why we need to look at what's been happening in the United States. And it's quite interesting to comment on the reaction to the outcome of this election almost 3 weeks ago. I saw reports a week or two ago that the Economist, on the one hand, saying it's been a very dangerous victory and a dangerous time for world markets, whereas today the Guardian newspaper, a more right-wing newspaper stroke media outlet, says Trump is about the last thing that's standing in front of the total collapse of the Western society. So that's how polarized the outcome of this election has been. So we need to ask ourselves the question, what impact will the victory of Donald Trump have on our investments and the investment strategy that we will be following at Brentis for our clients? But having said that, I need to go back in time. For the last 13 to 14 years, we have been very strong advocates of moving money offshore for our clients, whether it is through the 1 million rand per annum or through the official SARS application form for larger amounts, or through what we call asset swaps. And by and large, that has been a very, very successful strategy, not only over 1 year, 5 years, 7 years, 10 years, but it goes back to as far as 15 years ago. Something happened in world markets. And I'm going to show you one slide, or in fact, I'm going to show you 2 slides as to how this major diversion in investment returns has happened in markets. So I'm trying to share my slide, and But to summarize, if you have not had a substantial portion of your capital, whether you're a South African, whether you're a British investor or a European investor or Japan or Indian, if you did not have a substantial portion of your capital in the United States of America in one of their big markets, whether it's the S&P 500, the NASDAQ, or the Dow Jones Industrial Index, your performance has lagged very, very badly, as you can see on this chart in front of you. Now, this is a very, very telling chart. This is a 5-year number, and it shows you the MSCI USA index. That's the top performing line, the white. And that over a 5-year period has given you a return in dollar terms of about 90%. Whereas if you take out the American markets, in other words, you've only invested everywhere else in the world in dollars, but you had no exposure to the American market, you barely made about 20%. So you can see that there is a very, very large divergence. Now, this is the same graph, same comparison between the two ways of investing hypothetically, and you can see for yourself that the MSCI World, excluding USA, the total return over 10 years was 26% in dollar terms, whereas had you invested in the USA, you have a return of 190%. So it is not even a small margin of victory. It is a massive outperformance of markets, and this is central to the way we've been recommending our clients to invest. We did not fully buy into the local is lacquered kind of story, and there's a lot of reasons for this. And there are many reasons for this, and we can go back and spend a lot of time. We can talk about the Zupta years, the damage done by the ANC, but to summarize, big things have been happening in the United States. I myself visited the United States in 2014, 2015. I attended investment seminars. I visited companies like Facebook, Google, Tesla. I forgot that small little company run by Elon Musk. And there, together with my wife and a group of other financial advisors, we were exposed to this massive wave of innovation in the technological world taking place in the United States and in Silicon Valley. And I'm quite sure that Anthony will talk about this a little bit later. We returned to South Africa and we told our clients, you have to be invested in this part of the world. But lo and behold, you're up against vested interests. The media has a bias against recommending global investing. The big local fund managers have a vested interest in advising you not to go offshore. Plus, we have things like foreign exchange controls, which controls how much money the local fund managers can take offshore, but that has limited the growth on your investments over time. And I've got some charts here in front of me before I end up. I've just been looking at some statistics for investment returns, and quickly over 1 year, interestingly enough, we've had a very, very good year for all investors across all asset classes in South Africa. You know, I could not find a fund that has not produced 10%, but the average return on South African funds this year was about 14 to 16%, which was very, very good if you consider inflation is running at 4 or 5%. So you've made a lot of money. However, when you compare that to the S&P 500 benchmark, there the return was 30% for the year. And you can do it over 3 years. You had an average of 12% for South African equities, but Wall Street again, S&P 500, and it was a bad period. There was a very sharp dip in between, gave you 16%. But more tellingly, over 10 years, your return in the SA market has been 9% per annum. on average, give or take, whereas your return in the S&P 500 was 19%, so more than double the returns. So that is what history shows us. For the last 15 years, post the great financial crash, you as a South African investor, directly, indirectly, you had to have had a very large exposure to United States markets. So I'm going to hand you over to Anthony Ginsberg, as I said, ex-South African from Gins Global Funds. He has a wide range of funds, both global and offshore via asset swaps. But the one fund, the funds that we particularly like are the so-called tech mega trend funds, which has delivered fantastic returns over the last year. I think the one fund that we are invested in, Anthony, gave us 40% in dollar terms. Thank you for that. And Anthony will be telling you what's happening in the global world of technology, the products that we use on a day-to-day basis. But this discussion never takes place in South Africa. Fund managers, fund advisors, they really don't have a knowledge about the technology sector. So what do? They just don't talk about it, which is very, very costly to local investors not invested in this. Immediately thereafter, we'll be followed by Sean Peche, who runs the Randmore Funds. He's one of the top performing global funds in the world. We came across Sean's fund about 3 years ago when he was interviewed on Business News by Alec Hogg. I liked what I heard from Sean. I've never met him before. We made contact, we analyzed his style of investing, we analyzed his performance, and we said for our funds looking for a global type of approach, we would like to use some of his funds, and that's also done extremely well for our clients. So ladies and gentlemen, clients of Brenthurst, these are the guys making you money. So with that, I'm handing you over to Anthony, and immediately thereafter, Sean will go into his talk, and then we'll take some questions. So you're very welcome to send your questions to us, and we will try and answer them within the limited time that we have available. Thank you once again for attending, and over to you, Anthony.
Thank you, Magnus. It's a pleasure to be with you, and thanks for the support over all the years. First time you interviewed me, I was a young boykie in my early 20s, having just published a book on offshore investing. Since I'm still a boykie from Kaapstad with a plus naby daar, if you don't mind, I'll speak recht to you guys from California and cut through a lot of the mainstream media nonsense about Trump and all the scaremongering. Before I get to the tech slides, I can tell you the US is in for a soft landing. We can have a Q&A afterwards, but bottom line is we're growing at almost 3% GDP here. We're certainly the prettiest of all the ugly ducklings out there. I've just returned from a European roadshow, and a lot of the French and Germans and even the Brits I was with, I'm sure Sean can speak to this, were crying in their soup that they were underweight the US, just like Magnus was saying. Our inflation numbers just came out yesterday, again in the States. It's watched very closely by the Fed. The numbers were just over 2%, so we're on a declining track. It looks like the Fed most likely will, there's a 70% likelihood they'll drop rates again in December by another 25 basis points after dropping last month. So Magnus, things are looking up here. We're going to have Trump cutting red tape, probably lowering certain taxes. But in our tech space specifically, to get rid of the Biden-Harris administration is a wonderful thing for us. So let's talk directly about it. They blocked, with massive overreach, over 100 tech deals through their antitrust and Federal Trade Commission. There was a woman called Lena Khan there. She will be shown the door on the 20th of January. She still, even yesterday, tried to go after Microsoft again. She blocked a huge number of deals, including a Microsoft deal to buy the biggest gaming company. It eventually went through. But she's blocked airline deals. There's a nice little airline here called Spirit that it's gone bankrupt essentially this week because they blocked a big deal with them some weeks ago. So it's just massive overreach. And the bottom line is there's going to be a lot more freeing up of M&A activity. A number of our holdings in this tech megatrends, Magnus, probably close to 20 of the holdings could likely be on the acquisition block. These are mid-cap stocks, some small caps, some normal large caps that just couldn't be taken over or acquired. So corporate activity amongst my banker friends, I'm a former Wall Street guy myself, these guys were depressed the last 3.5 years. They're at the lowest level of M&A activity in Silicon Valley in almost a decade. So there was massive overreach on that. Talking about Elon Musk briefly for a moment, this efficiency drive, whether he'll ever be able to cut $1 or $2 trillion of fat out of the government will take time. But more importantly, Silicon Valley has switched to the Republican Party. Historically, Silicon Valley was very much a Democratic base. Kamala Harris, since she's from San Francisco, was a natural ally for them, but they saw the writing on the wall, and they see more deregulation and more outsourcing to companies that we own in megatrends such as cloud, AI companies, cybersecurity. So without further ado, I'm going to just briefly summarize this fund that you guys have been supporting for a number of years. We have a broader structure. We actually use 8 cutting-edge tech themes, including AI, robotics, social media, digital entertainment, cloud technology, cybersecurity, blockchain, which also goes by fintech in some places, as well as gene editing. And there are 120 holdings. What we've done is these are all established players, but it's equally weighted. So we don't have this massive overexposure like the NASDAQ does, just to the Mag 7 or the FANGs, which at this point dominate about half of the NASDAQ. Literally is made up of about 7 to 8 stocks at this point. I'll get to it in a moment. In our case, we're equally weighted, and every 6 months, it's rebalanced. So we're not taking a particular bet just on AI or just on cyber. They're equally weighted. And there's a reason for it, Magnus, and for your clients. The point is, increasingly, there's more and more convergence. Running these things in a separate silo, just looking at blockchain on its own or just social media, increasingly we see as a mug's game. Increasingly, we see a lot of M&A activity as well. Prior to Biden-Harris, but even now, we see the animal spirits returning, where you see cloud companies being almost like brothers to cybersecurity players, and including AI companies looking to take over players in the social media space. So trying to time it, if you go back 5-6 years, every year a different one of these sub-themes seems to win the day. It's almost like the pop charts, you know, going back when we were all kids. One year it could be David Bowie, and then maybe it's Kylie Minogue the following year, and maybe it's somebody else. So it's very, very difficult to time these particular sub-themes, but there is an increasing overlap or convergence. We use a global benchmark. So unlike the NASDAQ, which is 100% American, we actually do believe that in the robotics space, for example, the Koreans, the Japanese are actually ahead of the Yanks. The Yanks, we'll get to it in a moment on robotics. I'd like to just move on a bit. And as I discussed earlier, robotics will benefit from this onshoring. As the tariffs are raised by Trump, we don't believe it's going to be across the board. We see it as being more surgical, but robotics and automation in America will be one of the beneficiaries. And that's one of the reasons we own companies in that space. And just to summarize what I was saying, there was far less M&A activity than in almost a decade. So things are changing. There are positive tailwinds with the Fed cutting rates, not just right now, but also into 2025. We expect 3 to 4 additional rate cuts. And that's really the market's view. The market's actually thinking that the S&P will rise another 10% in 2025. If you look at Goldman and Citibank and a number of the other firms, the predictions are essentially around a 10 to 12% gain next year. I'll just move on. And I did touch on this briefly about the convergence between AI and cloud and things like social media and gaming. The biggest tech deal that actually did occur over the last 3 years was Activision, which is a big gaming company. It was acquired for over $70 billion eventually by Microsoft after massive delays because of the Democratic administration. But what I should just mention to you from a business point of view, there's been great relief here that there'll be less red tape and basically a freeing up of business and animal spirits. What's worth mentioning is that the quality tech stocks a number of them haven't actually run yet. So although we hear about AI stocks and things like NVIDIA and Palantir selling at very high PEs, there are many tech companies, including robotics companies, for example, and cybersecurity players, social media players that actually are not selling at massive multiples. And with lower interest rates, these are tailwinds, certainly for the mid-cap players and some of the smaller guys who are below the mega caps. It is a positive. So let's just talk about the fact that some people say to me, Anthony, but surely there's a tech bubble in those 7 to 10 mega trends. That's partly why we've taken the equal weighted approach to not overweight just the FANGs or the Magnificent Sevens, which is incredibly narrow. And we do see things like the NASDAQ as being a rather risky play. When we look at the equal weighted, more diversified, conservative way of investing in tech, you can actually get in at almost a 50% price to earnings discount on these 8 sub-themes. For example, the NASDAQ trades at the moment with a PE of around 32, 33 times. And our tech megatrend, it's an ETF listed on the London Stock Exchange. It's been around 6+ years. It's also on the German, etc. exchange and in Switzerland. That's trading only at about 19 times earnings. And then you look at things like price to book and price to sales that Sean knows well. We're at less than half the valuations of the mega caps, and particularly the NASDAQ. Just to give you an idea why one has to be careful and why we've always taken a broader indexed approach, is that the top 10 holdings in the NASDAQ represent essentially 50% of that index. But when you do a more equally weighted, broader approach, you can get that down to around 10, 11%. Actually, our mega cap weighting at the moment is 9%, whereas the NASDAQ is at 58%. So there are ways to go after the broader technology companies that actually have not all run. They've actually been held back by the lack of corporate activity, lack of IPOs. A number of them couldn't make acquisitions, which basically slowed everybody down. And in fact, even the most famous ChatGPT AI, Open AI, that could not be acquired. It had to basically be a minority ownership by Microsoft. And there are a lot of funny things that happened the last 3-4 years to get around the Federal Trade Commission and the antitrust blockages, where people were doing licensing deals and bringing people on board internally. So just to focus on these sub-themes very quickly, Magnus, AI as a size is actually, believe it or not, smaller than the cloud computing sector. So yes, there's a lot of hype around AI. It's growing in leaps and bounds. Here you see by the end of the decade, about over 2 trillion, it'll be almost $2.5 trillion market size from a very, very tiny level at the moment. So we're talking about essentially a 6-7-fold growth. And this is not just in the narrow part of AI. It's being pushed right across the tech spectrum. The biggest buyers of NVIDIA chips actually are our hyperscalers, our cloud computing leaders, such as Amazon Web Services and people like Microsoft's Azure and Google Cloud. Interestingly, the last third quarter earnings, the most impressive earnings were on the cloud side. You had Google Cloud up 35% year on year on their revenues. You had somebody like Microsoft's Cloud up 33%. Actually, the laggard was, I wouldn't call it a laggard, but that was Amazon with a 20% year on year gain. So these are all converging, and don't get too flustered by this busy slide. But the main point is that the plumbing and the mapping of technology, whether it's semiconductors or it's cloud or it's AI or social media, they are increasingly all integrated, and the plumbing is integrating them across the board. So trying to just pick winners is not that easy, but the main point really is AI is infiltrating itself across areas such as cybersecurity, even future cars here in Beverly Hills and in LA. You see increasingly more of these robo-taxis that are about to be launched. They've actually been approved in Arizona. My wife and I have been pulling up the last 2 to 3 months, almost every day now, alongside driverless cars here in LA. I mean, initially it was a little bit scary, but I can tell you they drive slightly slower than other folks, and they're much safer than my teenage kids or my older one who's in his 20s. And I've learned to trust them, but there are a huge number of them. It's actually run by Google, the main ones that you see out here. So it's coming fast, and that's using AI very much so. I wanted to get to the cloud market growth very quickly and show you just how cloud is growing. We're still in the early innings, as the Americans say. You know, baseball doesn't have 2 innings, it's got 9 innings. And they say here that we're in the 2nd or 3rd inning only of a baseball game when it comes to cloud, because actually only about 25% of work enterprise data has been stored in the cloud here. That's partly because in the early days, the highly regulated companies, such as banks, insurers, healthcare providers, were nervous to use the cloud and rely on outsourcing all their data. Today, most firms, big Fortune 500s, have multiple cloud usages. They'll have 3 or 4 different cloud providers. But this is just the level of growth. You're talking about 28.4% annualized growth for the next decade. So that it's a massive area, and it actually infiltrates things like gaming. My kids no longer use those gaming consoles that many of you may know that your kids or grandkids use. They're now doing it all on their mobile phones, increasingly with 5G or 6G, particularly in Asia. They are the largest per capita users of cloud in Asia, because they've got more reliable, fast-speed internet there. I'll just go through a couple other quick slides. The spending on cloud might blow people's mind when you tell them by next year, up to 50% of all corporate IT spend will be one way or another linked to cloud expenditure. And that's partly what's been driving NVIDIA through the roof as well. As I said to you, the largest buyers of NVIDIA FOSS chips are actually the hyperscalers, the cloud providers. Just have a couple other quick slides. Cybersecurity doesn't get as much attention. It's not as large as AI or cloud, but those players are increasingly on the horizon to be acquired, either by cloud or AI providers, or possibly even social media players, because they play a very, very important part. I can tell you, I can't get youngsters to come into my office more than 3 days a week. So work from home has propelled cybersecurity usage and also cloud usage, and that doesn't seem to be ending anytime soon. Just on the reshoring and with Trump, we think that his bark might be bigger than his bite, because this is a trade negotiating tactic for him to go after Mexico, as you've seen the last couple of days, and Canada. I mean, he really wants to stop the illegals crossing the border here. So there's been a lot more construction of manufacturing sites. Actually, the big German car manufacturers will be fine. Mercedes, BMW, they all manufacture already in the US. But the Americans, because of NAFTA, going back to those of us who've got a bit of gray hair to the 90s, the Americans were quite lucky. They were able to be lazy and offshore cheaply to Mexican labor and even to Asian labor, particularly in the car manufacturing business. What my point is, they haven't automated to the extent that the Koreans, the Japanese, the Germans have. And I think the big winner will be automation. So AI, robotics, they may well be the biggest winner from this onshoring trend. American workers are still not that cheap. They're expensive by the time you have to factor in Social Security and healthcare benefits. So I don't believe the trade unions here are going to be the big winners with millions of new manufacturing jobs necessarily. I think the robotic players and the automation guys are going to actually win out. I just wanted to summarize and show you there's these smaller, nimble robots called cobots. Some of you may have seen some videos of how Amazon uses them in their warehouses. These are collaborative robots, and they're smart robots. They use AI. These are the kinds of things we're investing in the robotics sub-theme. So each sub-theme we have in Tech Megatrends ETF has 15 leaders, and that's how we get up to 120 holdings across 8 sub-themes. So just to end off, this global chart is basically saying that the Americans have actually filed more patents and more robotic advances in 2023 than both China and Japan combined. And last but not least, we do see hybrids and electric vehicles and things like robotaxis coming thick and fast here. So we remain positive on that, and we're not surprised that Tesla has actually received a bump in its stock price. But to summarize broadly, the tech world here, Magnus, and in Silicon Valley is way beyond just the Mag 7 holdings, and those have been bid up significantly over the last year or two, and they represent in the case of something like NASDAQ, up to half the index. We think that is risky, and that's the reason why iTech, our megatrend ETF, has a smaller weighting, and we're much more broadly diversified globally. So America actually makes up 62% of our holdings, but we've got some Japanese, Korean robotics players. We've got a couple of the big Chinese leaders in there as well, like Alibaba and BYD on the EV side, and Baidu, because they're virtual monopolies and they do print money. And with that, I'll turn it back to you, Magnus. Thank you for your time.
Thank you very much, Anthony. We're going to go straight into Sean. We've got some questions coming through already. You're welcome to pose your questions. As expected, the first question was, what is the Rand going to do? And we'll deal with that a little bit later. So Sean, over to you.
Thank you, Magnus. And right, there we go. And thanks, Anthony. So welcome and greetings from early in Edinburgh, where I'm sure it's just as dark as it is in midnight in the States. But Anthony, he's raised the bar. It's a tough fact to follow, all those exciting things. And I have to say, I do agree with the more evenly spread option, especially with technology, where you can get some big winners. So onto my presentation here. And I must just say, this is not advice. Otherwise, I'll have an unhappy compliance officer. And just to quickly touch on what's happened briefly in the few days since the election. So this is the 2-year interest rates. You can see that interest rates have been rising. They're up a couple of percent. This is up to a couple of days ago. Because interest rates were up a little bit, and the reason interest rates rallied was because of the concerns of inflation, that tariffs will raise costs and that will increase inflation. That's one of the concerns. What that meant was that the euro has been very weak relative to the dollar. So in a few days, the euro has fallen 4%, sterling is down 3%, gold is also off around 4%. It doesn't look like it, but that's because of the scaling factor. Oil is down a little bit, not as much as you would have thought with the drill baby drill theme, but oil is down just a little bit. The real winner, lots of excitement in the Bitcoin space, and this is Bitcoin up 40%. Obviously, Trump, attended Bitcoin conferences, and you've got Elon Musk by his side, who's also a big Bitcoin fanatic. So lots of excitement in the Bitcoin space. So that's just a little bit of a backdrop. And if you look at the sectors, what sectors have done well? This is the MSCI World Index and the major sectors. The consumer discretionary, the big winner in that, you can see that's up 6%, though the whole index is world index up 2.76 since the election. But the consumer discretionary is up 6%. And the big winner there has been Tesla, obviously, with the strong rally you've seen. Finance, the big winners there have been some of the large banks, and I totally agree with Anthony in terms of the unlocking of M&A that's likely to take place in the US, and that's very positive for funds such as ours, which are able to participate in some of the mid-caps, and we certainly have a number of mid-caps that we think are takeover targets in the US. And the other winners, obviously, are the Bitcoin, the Coinbases, and those kinds of companies. Those are also in the finance sector. If we look at some of the big losers, one of the big losers is healthcare, and that is because of the concerns over what Trump policies are going to be and make America healthy again, what impact that's going to have on vaccines. And in material space, the losers have been some of the large gold companies, which have done well. So you can see, quite a dispergence between some winners and losers. So just to touch on a couple of things, and I really learned this all my years at university, and Anthony and I were reminiscing about our business science finance lectures earlier. But this is what I really learned from Sandy McGregor at Alan Gray. He made a very good point a few years ago, and that is that lower costs drive economic growth. Okay, and if you just think about it, the reason is the multiplier effect. So if costs are lower, then what does that mean? Let's just say you've got your home loan, and interest rates fall. Well, now you've got lower costs. What does that mean? It means you've got more money in your bank account at the end of the month, which you can then spend on going to restaurants. If you go to restaurants, now the restaurateur makes a bit of money, the waiters and waitresses make some money, they're buying goods from the wholesalers making some money, the employees of the wholesaler then in turn are able to spend. So lower costs drive economic growth. And what we've seen in recent years is far lower costs from things like globalization, etc. What do tariffs do? Tariffs increase costs. Okay. And so the concern is that increased costs will lead to lower economic growth. And that's not just, myself saying that and Sandy saying it. There was a study in 2019 that looked at macroeconomic data for tariffs for 151 countries, 1963 to 2014, and they concluded the same thing. So, these tariffs may just be posturing in terms of, right, we're going to just impose these tariffs and then get these guys and the countries to the negotiating table. And as Anthony's rightly said, Justin Trudeau picked up the phone straight away. But it's uncertain as to what's actually going to happen. And just to give you a couple of ideas in terms of what may or may not happen. So they have this policy, Make America Healthy Again. And what impacts is that going to have on the pharmaceutical industry? Could have quite significant impacts on the pharmaceutical industry and approvals. It could have impacts on the fast food industry and the packaged goods industry and the soft drink industry. We don't know what the eventual, so there's lots of knowns and unknowns. We know that Trump's won. We know he's got a disruptor by his side. The eventual impacts, we're uncertain at this point. And as to whether we're going to save $1 trillion or $2 trillion, this is what the US government spends on Social Security, health, debt interest, Medicare. Where is that going to come from? Is it going to come from defense? Maybe it's going to come from defense. Maybe some's going to come from health, etc. So the point I want to just make is there's quite a lot of uncertainties, and we have disruptors in charge. Okay, and generally speaking, uncertainty should lead to lower inflations, lower valuations. We certainly haven't seen that yet. Okay, we haven't seen that yet, and so. If you look at the macro forecast accuracy, there was an interesting study that I came across in what these guys did, the survey of professional forecasters, and they collected economic data from 1968 to 2024. There were 16,000 data points, and that was on economic growth and unemployment and all the rest. And they found that the forecasters only got it right 23% of the time. Okay, so and then a problem is if you guess the forecast of whatever unemployment or interest rates, you then still need to guess the market's response. And so it's not as easy as going, okay, well, if I get the unemployment number right, then I'm going to make a lot of money. You've got to guess the market's response to that. So what do we do? How do we operate at Randmore within that environment? We bottom-up value investors, and we just try and look for mispriced assets. And generally that volatility that comes from uncertainty throws up mispriced assets from time to time. And then when we find those assets, we'll invest like astute business people, like somebody like you buying the actual underlying business. What does this business make in terms of cash flow? What do we think a fair price is? What can we lose if we get it wrong? Because all investors make mistakes from time to time. And if there's an attractive return potential versus downside risk, then we will invest. And so what I wanted to say here, and why do we focus on the bottom up? Because valuations matter. And this is from JP Morgan's monthly book. They put together a very interesting monthly book. And what you've got over here on the x-axis is you've got price earnings ratios, forward price earnings ratios, okay, for the S&P 500. And on the y-axis, the vertical axis, you have returns, okay, 1 year subsequent, 1 year returns. And what you can see here is that, for a price earnings ratio of around 23, historically, there have been some years have given you 40%, some years you've lost 30%. So huge dispersion over 1 year. But if you're a medium-term, long-term investor, this is the same chart, but the subsequent 5-year returns. And what you see here is that the higher the forward PE ratio, the lower the returns. Okay, so valuations matter. That's why we value investors. We all like a good deal. If you're going on holiday, you're booking a hotel room, you're buying a car, you look for a deal. Why? Because it means your money goes further. It just makes sense. Sometimes in the stock market, people look back and go, well, that strategy hasn't worked for the last couple of years, but it just makes sense. Okay, and so to give you some ideas of the current valuations out here, what you have, this is, rather than use price to earnings ratios, I've used an enterprise value rather than price. And the reason for that is it brings into play the balance sheet strength. So if a company has got lots of cash on the balance sheet, the enterprise value will be lower than their market cap. Okay, because of the cash on the balance sheet. If they've got lots of debt, the enterprise value will be higher. And so this is the enterprise value to 12-month earnings, EBITDA. And for the very large companies, that's the USA Large Growth Index. You can see it has rallied hard. And so I think there's huge merit in the weightings of those large companies in Anthony's fund because of that. You know, you don't want huge exposure to these very expensive companies. Conversely, you look at something like the Topics 500, you can see that since 2009, it's actually much lower. And what you have here at 16 times is the S&P 500. And a company I'm going to talk about in a second is sitting at there at 9 times. Now, interestingly, it's a US company. And what you can see here is the mid-cap index is this sort of shaded green thing over here. So that is the USA mid-cap. That is up here at sort of 10 times. The large caps are 25.5 times. Now, who's going to get acquired in this environment of M&A? It's not going to be Amazon. It's not going to be NVIDIA. No private equity companies coming over the hill and paying 3.7 trillion for NVIDIA, but they are likely to buy in the mid-cap space. And so having some exposure to some of these smaller companies gives you some upside potential from this potential M&A. So we are more evenly spread around the world. We naturally down the bottom, obviously this US weighting that you see in the MSCI World Index, that is largely because of those very large companies that are expensive and we don't have exposure. So we have around 25% in North America, which is a little lower than Europe. And people might raise their eyebrows and go, well, goodness, what on earth are you doing having more in Europe and North America? Yes, the mood has been disappointing in Europe, but there are lots of potential positive catalysts. Hopefully Trump ends the war. That would be very good for Europe. You know, a weak euro is good for European exporters, etc. And there's some very well capitalized banks. So we're not taking a view on the European economy. We, as I said earlier, are bottom-up investors, and each company must stand on its own merits. All right, so the company I'm going to talk to you today, and it's one I guess we can all relate to, is Mattel, which is the #2 toys company in the world. And this is some of their brands, ones you'd be familiar with: Barbie, Fisher-Price, Thomas the Tank Engine, Uno, Hot Wheels, Masters of the Universe. They've got a huge number of brands. And what's interesting is, so they're the #2 company behind Hasbro, but they're the #1 in dolls and the #1 in vehicles. Now, Mattel was recently quite weak after the announcement because of the concerns of, oh, well, hang on a second, we import all our toys from China. Now we're not going to be able to import toys because of these tariffs. Of course, this year, you know, Walmart and Target and Amazon are not ordering their toys for Christmas on the 28th of November. And it's not just a Christmas thing anyway. And also it's less relevant, as I'll explain why. But that's the kind of fear and opportunity that we will seek to take advantage of. You know, to say, well, hang on, the first level thinking is, oh my goodness, tariffs are bad for these companies, but not necessarily. And so you have to look a little bit deeper. Now, the interesting thing about Mattel, they've got a new management team. They've been in place, I think, since 2019. Very smart CEO. And what they've done is they've grown revenue and cut costs. So often what you find is companies are either growing revenue, they don't care about the costs, or they're cutting costs and revenue shrinking. But these guys have grown revenue, cut costs, and by doing that, generated cash, and they've used that cash to reduce debt, and are now in the position where they're buying back $1 billion worth of stock. But the key is they're monetizing their content. So all of you will be familiar with the success of the Barbie movie, and the fact that some might not know that the Barbie movie was more successful than any of the Harry Potter movies. Okay, but that deal for the Barbie movie was negotiated many, many years ago. And unfortunately, Mattel only got 5% of revenue, far lower than they would certainly get with this new, the new team in place and the negotiation power that they have. And I think that's why we haven't seen an announcement of who's going to get Barbie 2, but you can bet there's going to be a Barbie 2. But it's not just about Barbie. You saw all their content. They've got 14 of their properties in active development. So if you've got young children in Netflix who watch Netflix, you'll know that Hot Wheels started this year. Hot Wheels, the first season was in March. It was so successful, they launched the second season in September. And they're doing Masters of the Universe with Amazon. They've got properties with Apple and Sony Pictures, and they've spread it around. And these are all in active development. They've got a Uno game, which is hugely successful, which they do with NetEase and generates them hundreds of millions of dollars of revenue a year. So really interesting when you look at their content. Now, how can AI, you think of dolls and you go, well, that's not going to be affected by AI. Well, in fact, it is, because you can use AI these days to make movies, to generate the code for video games that you couldn't in the past. Okay, so it's much easier. And what does that mean? That means there's far more computer games than there ever have been. But what's key is the computer games with the content, and Mattel have the content. So how much are you paying for Mattel? 12 times earnings. Paying 12 times earnings. Okay, it is only a $6 billion company. So you might say, well, it's only a $6 billion company, but why is it only a $6 billion company? What do you know that nobody else knows? Well, one of the things with this drive to passive investing and this focus on the large companies, okay, is that the smaller companies just fall by the wayside. And Mattel is only a 0.05%. This is the largest index that I could find its weighting in. MSCI USA small and mid cap index, it's a 0.05% in Mattel. And so if you own this, it's not going to move, and it gets taken out or acquired by any of these other companies in the same way as Disney in the past has acquired Marvel or those companies. It's not going to move the needle. But in a smaller active fund that is able to take advantage of some of these things, it certainly would move the needle. So that's just to give you an idea of there are always positives in whatever economic environment you're out there. We've got these positives in the potential unleashing of M&A. And so companies like this sort of size are bite-sized, because if growth is hard to come by for the large companies, one way in which they can grow is they can acquire smaller companies. And we have another company, Anthony, be familiar with it, Albertsons, which is in the process. There's a bid from Kroger to acquire Albertsons, which has been in place for quite some time now. The department, or the FTC, has also sued Kroger to try and stop this takeover, and hopefully that'll go through in the new environment. So that's all we do. We just look around the world trying to find these great opportunities. We've been doing it since 2008. We've grown 100 Rand to 1,000 Rand. And that's at a time when value investing hasn't really been in vogue. And it's been a difficult place to be. And we've managed in recent years to do that without exposure to the large mega caps. And so, that's why top advisors like Brent Hurst and others are finding value in that they can blend a fund like ours. It's very different to many of the other popular funds out there, and clients can have a smoother ride. Now, this was a quote. Some of you might have heard of this, but Jeff Bezos was interviewing Warren Buffett many years ago, and he said, Warren, you're the second richest man in the world, and yet you have the simplest investment thesis. How come others didn't follow this? And he said, because no one wants to get rich slowly. So we don't want to get rich too slowly, but we're not going to chase over and have huge exposure to the latest shiny thing. And we will just find the opportunities where the opportunities present themselves. So that's really my story. I better put this up, otherwise I'm going to get in trouble. But Magnus, over to you if there are any questions, and thank you for the opportunity.
Thank you very much. We do have questions, and of course, as I said, the outlook for the Rand is always the first one. And then we have some questions about Bitcoin. Maybe you want to take that call. And should we be concerned about quantum AI? I think it's a question for Anthony, but let me start with the question on the ZAR. I think in the 3 weeks since Donald Trump has become the new president, you can already see there's been a movement in the markets which is negative against emerging market currencies. and also the rand. The rand was trading at about 17, 20, 25 the day before the election on the 5th of November. And this morning it's trading at 18.25. Now, not so long ago, 3 months or so ago, the chief economist of the Old Mutual made a statement, and it was widely published in the South African press, and he would boldly forecast that the rand will go to 13 Rand 50 in the next 6 months. And, you know, he was again extremely bullish on the South African economy and the South African stock market like they've done in the past. And, you know, it's these kind of forecasts, and I think, Anthony, you made the point about forecasts, that I think are intended to mislead South African investors into not externalizing their assets. And I think it's shameful that the media doesn't pick up on this. But having ranted about that, the rand at 17 or 18.25 is probably without the Trump factor, 17.50 to 18 was kind of fair value. But the rules have changed. Trump is in power. He is going to put America first. There's some tariffs coming our way. He's not particularly fond of South Africa and emerging markets. So my view is that this is going to be perhaps the start of a slight weakening of the rand, although there are fundamental factors that are positive for the rand. Let us not be overly negative. We have had S&P uprating their guidance for the South African exchange, not upgrading it yet, but they're just adjusting their forecast. There is movement in terms of Eskom and things like that, but the economy is still extremely, extremely weak. There is no consumer power and so on. So one has to take one's cue from more than just one factor. So the rand at 18.25 could be going to 18.50 again. But what do you think, Sean, about the rand? Do you follow the rand? Does it play a role in your decisions? Or you just look at the dollar and the pound and the euro?
Yeah, Magnus, I don't follow it very closely. And as you were talking there, I thought, I should have put a chart. I put the euro and sterling. I should have put the rand. So that, I guess, just shows you. I mean, and you saw the accuracy of the forecasts at 23%. From and those are members of the Society of Professional Forecasters. So there's real risk in betting the ranch on the rand. And I just think that these days, we're all exposed to the dollar. If you buy an iPhone and you live in South Africa, you're effectively exposed to the dollar. If you travel overseas to Europe to go skiing, you're exposed to the euro. So why don't you just want to have a basket of currencies, exposure to a basket of currencies via a basket of shares? And that's the best way you can insulate yourself. And you're not taking the risk. You're not betting the farm on one currency, because who knows? So that seems to me to be a more sensible approach, I would think, rather than trying to bet on the rand. And I certainly wouldn't put outlandish forecasts. South Africa has to compete in a very competitive environment against lots of amazing countries and lots of, so that's what they're competing for, the foreign investor capital. And it's a competitive place. So that would be my view.
Can I just add one quick thing? There's been trillions coming back into the US since Trump won. So the dollar is also benefiting from a huge influx of capital. Just being in Monte Carlo a week ago and in London and Germany, these guys are crying into their soup that they were underweight the US, and there's a huge reallocation going on literally in the last couple of weeks. So we don't see the dollar weakening like others, and I wouldn't be surprised if the rand, it's hard to call it, but the rand's going to be up against it if you're just looking at it, a dollar rand, given the influx of money into the States at the moment.
Good answer. Sean, there's a question from Andrew Clayton, who's a well-known fund manager in South Africa, Advent Wealth. He asks, as a value investor, the SA fund managers flag as SA as a no-brainer for value. What are your views on this, as you have no allocation to South Africa in your emerging market allocation? So what he's basically saying, the South African fund managers are very bullish on SA as a value play, yet you as a global value player don't seem to agree.
Well, we've got two small positions in South Africa, one of which we're busy accumulating, so I can't talk to that. The other one is AECI, which we bought quite well and then did trim at a pretty good time as well. But the problem is, you know, I think people, you saw that chart of the EV to enterprise value, okay, for the last 12 months. You got Japan down there at 6. You've got Hong Kong, you know, at sort of 7. I mean, Anthony mentioned Baidu. We happen to own Baidu. Baidu's got 85% of its market cap in cash. You know, you've got these global leaders exposed to huge markets. So there's lots of cheap companies out there, Magnus, and that's what I'd say, and paying a very attractive dividend yields. You know, you can buy some, like a Dutch bank, ABN AMRO, exposed to the Dutch residential property market, yielding nearly 10% and are trading at half book value. So, you know, those are very attractive numbers. And so, you know, unfortunately, if you look broadly, there's lots of cheap markets out there, and you don't have to just take exposure to the local bias. You know, I mean, it's amazing. Even in the UK, people say, you walk down to the office block, and people go, "So how's the FTSE doing today?" I have no idea. I don't worry about the FTSE. I worry about global markets, you know. And so there's this huge domestic bias that if you're in the UK, you've got to worry about the UK market. And if you're in South Africa, you've got to worry about the South African market. And as global investors, we global citizens, we travel all around the world, we buy products all around the world. Global investing, you know, just makes sense to us. So that's so for we've got food retailers in America and in Europe, okay, on single-digit multiples. I mean, is ShopRite trading on a single-digit multiple? No ways. So the good companies, it's a bit like Japan, where the good companies are very expensive, and then the mediocre companies are cheap, but the mediocre companies are cheap, competing with the mediocre companies elsewhere in the world.
Sean, your expertise lies on a global basis. My reply to that question would be, SA fund managers follow and understand the South African market to the detriment of what's going on in the rest of the world. They're not interested because they can't invest in those companies. So that's the answer. You do it on a global scale, and I think Merchant West has just appointed you to run after their global value fund because you have experience in dealing with this on a global scale. Is that not correct?
Yes, that's right, Magnus. Yes.
So, and I've noticed on this point, Sanlam Investment Managers, one of our largest traditional life insurance companies, has just announced that they are giving their entire offshore book to 91 to manage, which is quite an acknowledgement that they're actually saying, we don't have the skills. You guys must run it for us. In exchange, we will get a percentage of the company, which is quite a deal, but I don't think it was spelled out clearly. It basically says that the local fund managers who know the SA market very well are not skilled to operate on the global scale. And that's exactly what we've been saying to our clients for many, many years, and they are buying into this. If you want someone to run your technology portfolio, you give it to someone like Anthony at Ginsberg Global Tech Megatrends, which I am personally invested in, and the returns have been astounding, and our clients are very happy. We don't have a technology sector in South Africa. Guys, we have one more question, but I'm not going to. They're asking about Bitcoin. I'm going to pass up on that. So let me summarize from what you guys have just told us, and for the benefit of our attendees listening today. The last 15 years has been a US story. It's been US to the detriment of the rest of the world. And if you've not had a very large exposure to the US markets, we suggest you getting the second opportunity to increase your allocation to the United States, or funds that are invested in the United States, or even globally. I still think, as Sean said, we are catering for very global South African citizens. Their children are increasingly immigrating. They are working abroad. A lot of South Africans are retiring abroad. And more importantly, even if you don't want to retire offshore, a lot of your consumer goods that you are are spending your money on is linked to the dollar and not the rand. So if you want to become poor in South Africa, I always tell people, carry on investing in rands and looking at your rand returns. Your dollar returns will determine your lifestyle. Guys, we're running out of time. I'd like to thank you for your time. And just to summarize to our clients listening and to our non-clients, if you want bigger exposure to the US markets, which I recommend very strongly, talk to your dedicated financial advisor. We now have 9 offices countrywide. We've got 25 financial advisors, all highly qualified. We've had a fantastic year at Brentest. We've celebrated our 20th anniversary. Assets under management well in excess of 20 billion rand. We're very proud. We consider ourselves to be the largest independent IFA network in South Africa. And we can only do this by investing in funds that one has to go and find elsewhere. Anthony's funds, Gins Global, Sean Peche from Randmore, and others. So we'd like to thank everybody involved in this today, our listeners, our guys who put it together, Darlene and Sue, and to everybody, a fantastic Thanksgiving for you, Anthony, and of course, quite soon to the South Africans. They all go on holiday, and a Merry Christmas, and to all in a Happy New Year. So from my side, it's always great to be this side, talking to you, trying to educate you. And with that, I say good night.
Thank you, Magnus.
Thank you, Magnus. Thanks, Anthony. Nice to catch up again.
I hope to see you one of these days in South Africa.